Hey everyone. In today's video, I'm going to explain why I'm investing in SCHD, which is the Schwab U.S. Dividend Equity ETF. For the right investor, SCHD could be a great addition to a long-term diversified portfolio. Since it launched in 2011, it's delivered an average annual return around 12.3%. That 12.3% average annual return shows just how powerful SCHD has been as a compound investment. Now, past performance doesn't guarantee future results, but if that rate of return continues, your investment could double about every 6 years. That's some serious compound growth. I don't know about you, but my goal with investing is to get rich slowly. I'm focused on the long term, and that involves utilizing a well-diversified portfolio of stocks that grow over time through dividends or capital gains. In this video, we're going to break down everything you need to know about SCHD, its investment objective, the index it tracks, how it picks stocks and sectors, current top holdings, expense ratio, and dividend yield. At the end, I'll also go over my personal list of pros and cons, who should or should not consider investing in SCHD. Let's begin with a quick overview of the fund's objective. Straight from the prospectus, the fund aims to track as closely as possible, before fees and expenses, the total return of the Dow Jones U.S. Dividend 100 Index. In simple terms, SCHD is an ETF index fund. It follows the performance of this specific Dow Jones Dividend Index, which is made up of high-quality U.S. companies with strong histories of paying out dividends. For the everyday investor, this index offers a passive way to invest. In other words, when you buy shares of SCHD, you're letting the index do the work for you, picking stocks and rebalancing the portfolio based on its stated criteria. Now let's move on to how this index picks stocks and sectors. All index-eligible stocks must have sustained at least 10 consecutive years of dividend payments, have a minimum market capitalization of $500 million, and meet minimum liquidity criteria. No one single stock can represent more than 4% of the index, and no single sector can represent more than 25% of the index. The index composition is reviewed annually and rebalanced quarterly. As of the time of this video, its top 10 holdings include Texas Instrument, Pepsi, Chevron, ConocoPhillips, Cisco, Merck, Amgen, AbbVie, Bristol-Myers, and Coca-Cola. SCHD is diversified across sectors such as industrials, financial, healthcare, consumer staples, and others. The total expense ratio of this fund is just 0.06%. It pays out a dividend every quarter, and its distribution yield as of 6/30/25 was 3.87%. That means that it's paid out dividends of 3.87% over the last 12-month time period. Now let's get into the pros and cons of SCHD. The first pro of this fund is its investing objective. You may want to consider investing in SCHD for a blend of income, quality, and potential long-term growth. This dividend income could be a great option for anyone, especially those nearing retirement who are seeking steady cash flows. The second pro is the tax-advantaged treatment of its qualified dividends. Most of the dividends from SCHD are qualified dividends, which means they're taxed at lower rates, such as 0, 15, or 20%, as opposed to your regular income tax rates, which could be as high as 37%. The third pro of SCHD is diversification. For example, the S&P 500 is another popular index fund, but this index fund is currently very top-heavy in tech stocks, and its largest 10 holdings make up about a third of the entire portfolio. By adding SCHD to the mix, you spread out your investments and reduce your reliance on the U.S. tech sector. This diversification helps balance out your overall portfolio. Now let's get into some cons of SCHD. SCHD is not necessarily ideal for high-growth investors. In other words, the holdings in SCHD lean more towards value stocks with mature business models, as opposed to newer, fast-growing stocks. It also does not offer international diversification, and its current year dividends could cause a current year tax liability. Now, you can potentially mitigate this current year tax liability by investing in a qualified account, such as a Roth IRA. Let's wrap this video up with a bonus question. If you do decide to invest in SCHD, should you reinvest the dividends? Well, I believe that if you don't need the cash right now, and you believe in SCHD's long-term growth, then yes, you should reinvest the dividends. This is called a DRIP, or Dividend Reinvestment Plan. If you're using a Schwab brokerage account, you can easily turn this on by updating your settings, which I'll show on the screen right now. So there we have it. In this video, we answered all sorts of questions about SCHD, such as what is the fund's objective? What index does it track? How does it pick stocks and sectors? And what are its current top holdings, expense ratio, and dividend yield? I hope after watching this video, you're now better equipped to make an informed decision on whether or not you think you should add this fund to your investment portfolio. If you found this video helpful, please hit that like button and check out my other videos. Thanks for watching, and I'll see you in the next one. Take care.